Diversification is a classic concept in investing, which begs a classic question. How should I be diversified? How much should I diversify as an investor? That can mean a number of things and can be taken in a number of ways. I'm going to focus on the first one, which is how many stocks does it make sense to own in one's portfolio? We could also talk about diversification among asset classes, bonds, stocks, real estate, cash, whatever else. We could talk about whether owning a house affects how you should invest in stocks. Or even a friend of mine had the concept of diversifying your human capital. If you work in a given field, that should affect whether you diversify out of that field so that your eggs are not in the same basket for your career as for your investing. All of those, again, are valid, but today we're going to focus on the question of how many stocks does it make sense to own in your portfolio? There's no perfect answer. There's no guidance that comes down from the mountains that we can share here, but I'll share how I approach it, and more importantly, the considerations you should have in mind when you're deciding what's right for you. And before we go further, I'd like to introduce myself. I'm Daniel Schwarzman. This is a short investing guide. You can subscribe to this channel to get more of these videos. And also, I'd like to emphasize that your experience is a big part of this. And the short answer, I'll explain more, is that the less experienced you are, the more diversification can help you. But let's get into it. Don't put all your eggs in one basket. Classic edict, and one that I've already used on this video and that underlines the reasoning behind diversification. If we own multiple stocks, we're keeping ourselves in the game because no one stock is likely to torpedo our entire portfolio. It gives us the opportunity to protect ourselves from being wrong because we don't know the future. If we knew the future and we knew which stocks to buy, amazing, we would do that, but we don't. We will pick stocks, and there's every chance, every time we pick a stock, that we can get something wrong. Even beyond that, even beyond getting things wrong, stuff happens. Either we take something on a 75-25 guess over a certain issue, and the 25% plays out, and we feel bad, but we may not have made a mistake. We may have done the right thing. Or stuff in the world happens that we can't anticipate. Our job as an analyst is to anticipate as much as we can, and there's still things that we're not going to be able to see. I would be dubious of anybody who's claiming that in 2019 they were prepared for a pandemic and knew how it would affect all their portfolio stocks. It'd be hard because even the most obviously hard hit stocks in some cases did amazingly well. So it's not always easy to even foresee what these black swan events are going to do to our stocks. By spreading out our stocks to 10 stocks instead of just one or two, we give ourselves a better chance of staying at the table, which is the most important thing in investing when it comes down to it. Keep your seat at the table, survive, and then you'll thrive. We give ourselves a wider opportunity. We give ourselves the chance to get things wrong. And contrarily, because it's hard to pick good stocks, taking 10 shots on goal instead of just 5 might give us more chances to get one really right, which is going to make a big difference in our portfolio. And if we're a newer investor, it might teach us more to pick 10 stocks and follow them instead of just 5. Another part of the benefits of diversification. Of course, everything that I just said can be inverted to be an argument for why we shouldn't diversify. It's hard to find good stocks. Let's start there. If you're going to have a hard time finding good stocks, why do you want to spread yourself super thin? There's a saying in investing that your 10th best idea isn't as good as your first. And then, of course, your 50th best idea is not going to be as good as your 10th. At some point, being sure about yourself is a better bet than spreading yourself thin. Again, the old phrase from Buffett, wait for a fat pitch that you can swing at. The other thing to keep in mind is that even for new investors, it's hard to follow stocks. It's hard to keep on top of them. It's hard to know them well enough so that when bad things happen, you know if it's a really bad thing or an opportunity and so on. And that's where you can make a lot of your money. Following too many stocks, you lose track of them. You can't stay on top of them. You're really spreading yourself thin, not just in terms of your investment firepower, but in terms of your analytical abilities and your ability to actually bring value to the table in terms of investing. There's a concept that kind of captures this, which is diversification, obviously the flip side of diversification. The idea is that if you just add stocks to your portfolio to diversify, you're basically watering down your results. You're just putting stuff in there. And while at some point diversification makes sense, there's a point where you can go too far. If you have 10 stocks and you get one really right, that can make a big difference. If they're all equal and then one of them doubles, that's a 10% difference in your portfolio. If you do the same exercise with 100 stocks, that's only going to make a 1% difference in your portfolio. If you have so many stocks, what's the point of investing in individual stocks and spending so much time? You may as well just invest in an index fund and get your diversification that way. I'm not going to weigh in yet on my opinions, just presenting the two sides, but let's put in a few other considerations that you should be thinking about when we talk about diversification. Starting with this one. How much money you're actually putting in the market, and then how much you're saving are both really important, and really where you are in your financial life. If you're at the beginning of your investing career, if you're still young enough or early enough in your process where you're trying to accumulate wealth rather than protect it, diversification actually can get in your way. In other words, to some degree, you want to be concentrated. That's where you'll make your big money. And when you get one or two stocks right, that stock over time will change your life in a way that is hard to replicate with 15, 20, 30 stocks. Whereas if you're at the point in your career where you're more concerned about protecting your wealth, diversification is a nice defensive tactic to do so. It spreads out the wealth. It makes it less likely that anything is going to sink your portfolio, sink the money that you've built up over the course of time. That's one consideration. Diversification is somewhat defensive, concentration is somewhat offensive. But also important is where you are in terms of how you're saving money. If you're in a part of your life where you're saving a lot of money, where you can expect your career to continue for years and decades, and you expect to continue to add your savings over time, that's also an argument in favor of less diversification. Because to some degree, you can think about the money you're going to add into the future as a form of diversification. Again, it depends how confident you are about your career, but if you know that you're going to continue to add money over time, that'll become its own form of diversification, as long as you're not continuing to sink money into the same losers that you've had in your portfolio for years, something like that. But in general, that's another consideration. Your risk tolerance matters quite a bit here for diversification. And you can probably guess where I'm going to go with this, but there are two things that I want to focus on with risk tolerance. Risk tolerance can mean a lot of things. There are terms like aggressive, conservative, and so on, but I think two things here matter. First, your time horizon. How long do you have for this money to stay in the market? If you only have 2 or 3 years, then you're going to need to be more cautious about burning that money because you're going to want to be able to take it out in 2 or 3 years. If you're thinking about decades longer, then you can really think about, I have time, I'm going to continue to add money to this, I can afford a bad year. That would be an argument more towards concentration. Not that concentration diversification means good, bad year, it's just how exposed you are to certain things. The other thing is more in your guts. Risk tolerance, really the biggest risks that you have. Of course, you get stocks wrong, they even go bankrupt, you're never going to get your money back. But the biggest risk you have is waking up, seeing your portfolio down 5, 6, 7, 8%. How do you stomach that? Does that make you throw up? Does that make you want to sell everything and stop? Or you say, let me see what's happening, but it happens. This is part of the game. I had an issue on October 5th, I think, of 2023, where I woke up, bad news for 2 stocks in my portfolio that made up more than 8% of my portfolio. They dropped over 25% that day. I saw my portfolio drop more than 2%. That hurt. That was a lot. And I'm relatively well diversified. I'm managing a lot of people's accounts and so on, but that still was really hard for me. That was something to stomach. But I have the stomach to last through that, to step back, not do anything rashly. And I did my research and I got through it. But that's an illustration. That's what you want to think about it. Famous investor who I quote from time to time, Joel Greenblatt, used to talk about running a very concentrated portfolio. preached the idea of 6 to 8 stocks, which I'm going to talk about in a second. That my understanding that comes from him. At the same time, he got to a point where that sort of heartburn he would get from one stock really dropping bothered him. And now he runs investing portfolios that are very diversified, that focus on a few different strategies, but are very diversified. A big change. So how you feel about this can change over the course of time. And again, no one right answer. I've said this before, and I'll say this again as the last piece. The more experienced you are, the more confident you are in your decision making, the more you can concentrate and use diversification a little bit less. That's no promise, of course, we can get overconfident, but it makes sense that as you understand more of what you're doing, if you have the mindset for it, you can focus your investing in fewer positions. Whereas if you're a beginner and you're still learning this, it makes more sense to give yourself more shots on goal, both to get things right and to learn more, and because you're not sure what you don't know and what's going to get you into trouble. That experience matters. Now, there's no literal every year you can get more concentrated or whatever else. You're going to learn more what suits you. But I think as a starting mindset, it makes sense to lean more towards the diversified scale than otherwise until you get your druthers on how to do good analysis, how to pick stocks, and also what suits you. Here's where I weigh in. And this is not strict investing advice or investment advice. It's just how I think about diversification. And then I'll talk about how I actually approach it in my portfolios. But here's where I weigh it. Diversification is a valuable tool to have in your toolbox. It's smart to not put all your eggs in one basket, no matter how well you know that basket. I just think that's generally a good rule of thumb because things can go wrong. That said, studies have shown that the benefits of diversification more or less start to peter out after you have 6 to 8 stocks. Your diversifying of non-market risk goes down meaningfully after that. So 6 to 8 stocks is really the starting point. For whatever reason, I like the idea of looking at 6 to 10 stocks. Think about 6 to 10 stocks as where you would start in your diversification. Then you can factor all those considerations I mentioned earlier and tweak one way or the other. But that's where I would start if I were working fresh with just my own money. 6 to 10 stocks where I can get a sense of the stocks. I build a watch list that's about double those number stocks, 10 to 20 stocks. And then I can follow, that gets me 20 to 30 stocks that I'm following. I'm always trying to learn more, but that gives me enough where my winners make a big difference. If I screw something up, it won't kill me and I can continue to add over time. That's where I would pin the sort of starting point around which we can deviate. Couple things that are important though. First of all, you actually have to be diversified. When I say 6 to 10 stocks, if you own NVIDIA, AMD, Intel, Broadcom, and Taiwan Semiconductor, and those are all semiconductor companies, you're not very diversified. Yes, they have different things going on, but they're all pretty much the same sort of play with some nuances. There was a meme going around in 2020, 2021. A lot of investors online talked about how diversified they were, and they listed their portfolio stocks, and they were all the same 10 to 20 stocks, all software companies, all with similar end products, similar business drivers, and they all had similar performance. When things were going well, they all did great. When things weren't, they all did poorly. It wasn't real diversification. You have to be honest about what type of diversification you have. And then from there, you have to see what works for you, where you fit in on the line. Where do you want to be more diversified or less diversified? 6 to 10 is a starting point, I think. One other nuance here. Let's say you're an index fund investor. It's perfectly fine. You invest in an index fund, but then you get one idea that you really love. You say, I've heard of this new restaurant or this new product, or I've been using this new thing at work and I find that it's super helpful, or whatever else. You get a great idea. You do work that makes you feel comfortable with it. Don't feel like when you sell part of your index position to invest in this other stock or whatever else, don't feel like you then have to diversify. This is another way to think about it. If you have an index fund that's taking up a majority of your portfolio, the money you leave over to invest in stocks doesn't have to be diversified to 6 to 10 stocks. It can be in just one or two, depending on how much. Say Say your maximum position you're comfortable with is 20%, just as a number. Then the other 80% is an index, you're diversified. The index is a diversifying tool. That's important to keep in mind. That's another way to think about it, which kind of splits the difference because you're still then only focused on one or two stocks, but benefiting from the diversification of an index fund. I'll wrap up with how I diversify. When I started back in 2011, I had a very by the numbers approach. I'll confess, I read Jim Cramer's book and Mad Money, and I found it useful. And I used that as a starting point. I said, all right, I need this type of stock. I need this type of stock. I need to get at least 5, and then I try to get to 10. I bought, I think, 16 stocks in my first year investing. I sold 5 of them relatively quickly, so I had 11 stocks left over. I wasn't terribly diversified. I had quite a lot of healthcare for whatever reason. But that's where I started. That was where my head was at. Then I started managing my wife's account and other people's accounts in my family. And at first I had a weird concept of diversification where I said, okay, if I have this stock in my account, I shouldn't have it in my wife's account. And I shouldn't have it in this person's account or that person's account. I tried to diversify at a gross portfolio level, across all the portfolios I manage, which led to me managing 35, 40, 45 stocks and not really getting any benefit from really understanding one or two quite well. I got over that and eventually got to where I am now. I own 26 stocks plus 1 short position. They're spread around across the portfolios that I manage. There's a lot of overlap in those portfolios. And individual portfolios have anywhere from 11 to 25 stocks, which there's no magic about it. The smaller the portfolio, the fewer stocks it has. Other than that, I just like to have some diversification. And since I'm already doing the work already as a portfolio manager, it's kind of all the same. So we have 11 to 25, 26 in total. I then have a watch list of another 25 or 30 stocks that I'm trying to follow or thinking about adding or whatever, trying to continue to do work on. That's a place where my winners can still have an impact. I had 2 stocks in 2023 that boosted my portfolio by nearly 6% apiece. So they had a real impact. But if anything went really bad, I knew I could cut my losses, not impair my whole portfolio. And partly for me, it's that as much time as I've spent as an investor, I'm never really that confident in my own opinion. I'm somebody who likes to hear the other side, who can find empathy for most people and most participants in the market. And so I'm never super, super confident. My way of dealing with that is let's spread out a little bit. I think I'll be right, but if I give myself enough shots, these will turn out well over the next 2 or 3 years, I hope. And that's how I manage my portfolio. I'm risk tolerant. I said I can stomach bad days. I fortunately have a long-term time horizon, but my confidence, my analysis is the major factor in why I spread out a little bit more. And that's where I've gotten to today. That's how I approach diversification. It's not necessarily the right way. It's the way that I feel most comfortable with. And I should say, while I have 26 stocks, I've also been trying to build starter positions quicker or to be more open to taking small positions that either I get rid of or I eventually build into more. My top 13 stocks, so half of the portfolio, makes up more than 60% of my portfolio. And 20% of my portfolio is in cash, which another type of diversification. So there is a reasonable amount of concentration in those top 13 or so stocks. So just take that as a way I balance between concentration and diversification. Your level of diversification is sort of like your investing style. It will be unique to you, and you need to figure out what works for you. There's no one perfect answer. I've been told by a number of people, investors I respect, that I'm too diversified, for example. Some people like to only invest in baskets they're watching really closely, so they have fewer positions. That works for them. There are other investors I know, professional investors, who like to have 100 stocks or more in their portfolio. Neither of those paths are for me. I am where I am, and you need to find out what's right for you. I hope this video is helpful for you in thinking about why we care about diversification, what the trade-offs are, and what considerations you should be bringing to the table when you consider how you want to diversify your stock portfolio. This is the first video in How to Build a Stock Portfolio, my second course on a short investing guide. Subscribe to get more of these videos. Check out shortinvestingguide.com. Check out middlecoastinvesting.com if you want more of my stuff about the stock market. Thank you for watching. My name is Daniel. I hope to see you next time.